All right, Matt Gougé, Get Better Everyday Podcast. I'm excited. I got my good buddy, Dan Maybaum, founder of Answer Home Loans. You know, just all around good dude. How you doing, Dan?
I am well. Thanks for having me out here.
So many different things we could talk about. We could talk about investing. We could talk about the mortgage industry. We could talk about life in California. But maybe let's set the stage. Who is Dan Maybaum?
Okay, so first and foremost, a family man. Married for, I guess I've been with my wife 18 years, which I think is quite an accomplishment.
Shout out to Nicole for putting up with you for that long.
Right. And then twin daughters. They are 13 in 8th grade, soon to be 14. So I think that's what defines me primarily. Been doing the mortgage game for even longer than I've been with my wife. So I'd say that is a defining characteristic of me. Been a business owner and an entrepreneur for about half of that time, about 10 years or so for that. And a recently birthed pickleball player.
Nice. Yeah. The next stage of life for a lot of us is, they find passion in pickleball. I haven't yet played a game of pickleball. I know you've been asking me, so I'm sure
get you out there.
I'm sure I'll be out there. And so, I guess we'll start with the mortgage stuff, because I think it's interesting. Like you said, you've been 2+ decades in mortgage,
right?
10 of that as the owner of your own company. So you get the view of mortgage, I know, right? As a loan originator, like where you started from a business owner who's around mortgage loan originators. I think I'd love to hear your opinion on the current landscape and what you see going forward. Because I think if there's anybody who's got a finger on the pulse, it's probably you.
Yeah. I'm excited and optimistic, to be honest. I don't need to tell you, like, the last 2.5 years have been, a relatively steady march downward, a little bit switched up this year. But if I'm looking at the tea leaves right, and I think I am, I think the next 12 to 18 months are going to be a real turning point for us. I think, it's pretty clear at this point we're entering a rate declining market. And I'm excited about the near future for sure. I think we're going to get back to doing a lot of business and making some money again. And we're all a lot happier when that happens.
The 80,000 loan originators across the U.S. that are still licensed and still alive, love to hear that, right?
How insane is that stat?
Yeah, those of us that are being honest realize, like you said, the last 2.5 years have been tough.
Yes.
Anybody who says that it hasn't is lying to themselves, right? As somebody who was able to generate a lot of business, right? And from 14 to 21, I just had this, run up year after year after year, just kept getting better and better.
I had a front row seat to it. Right, it was awesome.
And I'm sure I'm not the only one who just thought, like, why would things ever change? Right. It's just, the sun is always shining. And then, 2022 and 23 hit a lot of us in the face: loan originators, real estate agents, escrow officers. So thank you. I'm glad to hear that you too see light at the end of the tunnel,
for sure,
and brighter days ahead. What I'd love to ask next, dude, this is great. This is like a counseling session for me. What things going into 25 and 26 do you see, maybe from a business owner perspective and from a loan originator perspective, can you use lessons from 22 and 23? Because you get punched in the face, you realize, like, there's not always going to be endless amounts of business and money. So a lot of us have tightened up, processes and probably spend. What are you going to do different this go around from the last probably,
and this is this is just a general life thing, but like I went through probably my second iteration, if I'm being completely honest, of acquiring stuff. I had a house with a vineyard and, all kinds of toys. This kind of made me realize that maybe I'm not a toy car guy. I had some toy cars and things. So humility, I think, is something that you always have to, like, try to keep foremost in your mind, because life and this industry will definitely humble you. And just when you think you have it all figured out, things change, and and it will humble you. So I think humility is incredibly important. Don't overextend, get addicted to acquiring assets that are, that you say, like saving, and assets that produce rather than assets that are a liability. Cause you can get addicted to that stuff. Like that is something in the last 10 years that I've become more and more addicted with what I consume on YouTube or whatnot. You can really like get excited about that type of stuff, just like anything else. And so I think those are healthy things to do to like set yourself up to, not make those types of mistakes when things change and whatnot.
Yeah, right.
Yeah.
Whatever the chemical thing is, the dopamine drip is real, and it's exciting to have a new car. It's exciting to have a big house.
Yeah.
You and I probably both know some people that, in this latest run up, like you called it, we're out there spending money on the wrong things. I also know an equal number of people that did the right things, acquired real estate that produces income, and did a lot of smart things to where now it's like, hey, business is slower, but I've got a relatively modest lifestyle. I've got real estate that's producing income. Me and you talked a little bit about lunch. You've got other investments outside of mortgage that are going to, sustain you in, good and bad times.
Yeah.
With that being said, besides mortgage and in the day-to-day operations of that, what else in the business world excites you, or what are you looking at right now?
I love researching investing. I don't think that I'm not like out putting 80% of my net worth in Bitcoin or anything, but I like crypto. I think it's an exciting avenue, and, I definitely dabble in it, but yeah, I love doing the research on that type of stuff and finding, interesting ways to deploy money that I think are going to be better than, the 5 or 6 or 7% returns that you can get through more conservative avenues. So I do spend a lot of time in pursuing that type of stuff, and like you said, get my dopamine hits off buying assets and things. I do enjoy that. I'm helping fund a development here locally in a town called Roseville that you and I live near. And, investing with a venture capital firm that's super exciting. Like, they're out buying companies and helping companies grow. And it's new and exciting and fun stuff to participate in.
Yeah. Yeah. I think for most entrepreneurs or people who, understand business, it's just like a game. It's like Monopoly, or it's like any other game. It's like,
Totally.
I'm going to figure out some strategy and ways that I can win. Different people have different strategies. So,
but like any game, it's like, it's really easy to lose.
Right.
So you got to be careful. You got to make sure you're only doing these more exotic things that are new to you with money that you're like, okay, if I lose every penny of this, I'm okay. You just don't want to like I said, put all your money in Bitcoin or anything like that.
You bring up a good point. Me being active originating loans, I'm talking to people every single day. Wins, losses, lessons, right? And so when you mention that, only put in the middle of the pot what you're willing to lose, right? If you're playing a game of poker, could you share with us, if you're down with being vulnerable enough, like maybe your biggest loss or your biggest lesson in terms of, on the investment side?
Well, yeah. I got into the industry in like 2002. And so, like your experience of 14 through 21, 2002 through really like middle of 2007 was a pretty meteoric rise, right? So that's all I knew. There was a point in my career early on, believe it or not, where I had never done an FHA transaction and I had really never done a purchase. They seemed super exotic to me. I'm like, I just do refis, and I do subprime refis a lot. It was a very different world. And so at one point, I had 3 or 4 homes, and I was, getting ready to marry my wife and whatnot. This was before the kids were born. And, I had what I thought was a lot of assets at that point. And I thought, I was going to be safe with that. And that all went away.
Right,
That all went away.
Yeah.
Like
yeah.
every last dime of it, you know?
And I see it too, right? And people think like, how did this person with X number of assets or X number of dollars or this big of a business, how did they lose it all? And man, I've seen it. And I also can relate with how easy it is, you know, when you go from making a certain number per month and you've got, you know, revenues from different investments all kicking off and those start to dry up, your income dries up. I can definitely see it, which, you know, brings me to that epic, you know, real estate crash. Most people across a bunch of different industries were affected. But, you know, from your standpoint, I'd love to hear some stories, man. I don't know. Maybe tell us a story first about the meteoric rise and some of that stuff.
Well, I do have a funny little anecdote. So, most everybody's seen the movie, The Big Short. Less people have probably read the book, but I bought the book and read it well after watching the movie. And the book opens and it's talking about 2002 and it's talking about Household Finance Center, HFC Bank. I got into the mortgage industry in 2002 for Household Finance Center. Like literally the first chapter of the book was like, that was me at that company. And so it was super triggering reading this book because I didn't know. I was like, the year prior, I had gone to work for my uncle who owned a small construction company. And this was right after I got out of college. And we were doing a job down in Vallejo. And I started in November and I literally was like in a ditch in the rain in Vallejo. And like, he liked to work 7 to 7 every day, 12-hour days. And sometimes we'd work Saturdays. So like, that was my life for like a year right after graduating college. And so after about a year, I was like, what am I doing? I didn't get a college degree to like be digging ditches. And so a roommate that I had was working for this company and I went to work there and I was like, oh, 8 hours a day in the air conditioned room. And I'm pretty decent at sales. Like it was like a dream to me. It was the easiest, best job ever. And I was pretty good at it. And so I didn't know any better. I was like, this is the greatest job ever. Like I could do this all day. And so, yeah, that's where my career started, is the opening chapter of the book, The Big Short.
Yeah. And I love the old stories. As somebody who didn't get into mortgage until 2014, you know, I was around. I was a college graduate in, you know, 05, and then ran a small business, the Poker Room, right? Yep. And so I've got clients who are real estate agents, clients who are mortgage brokers. I knew enough, right? I got a finance degree. I love numbers to kind of see what was going on. And right. Funny, you know, side note story. I think you've probably heard this, but I went and applied at AmeriQuest. Oh yeah. And part of the, you know, I don't know if it was the application.
That was my second job in the mortgage industry.
I don't know if it was part of the screening process or not, but they were basically telling me like, how much are you willing to lie? How much are you willing to cheat? How much are you willing to forge the signature? And when I was, you know, newly graduated from college, you know, so I just spent a year and a half in Mexico, and I was like, listen, I've got business acumen. I've got work ethic. I don't need to cheat. I'll beat all these guys doing things straight up. They were like, no, straight up is not our style. They didn't hire me.
See that? I wonder who you interviewed with, because that wasn't my experience. With time, I saw that was the reality of that place, but it wasn't so blatant when I went to work there. But that's interesting because it totally makes sense. There was a certain element that I could see interviewing you like that. And so I only was there for about 8 months because I was like, I got to get out of this environment. Like,
right. Yeah.
Even being, you know, 24 or 5 years old, I was like, this is not a healthy.
Not it. I'd love to hear from that household finance, you know, up through it. Take me through the different places you worked. You know, it's cool stories for me just to kind of hear like how those companies operated. I'm sure 20 years later.
So Household Finance, and there was another, its sister company was called Beneficial, and they had like brick and mortar retail locations in like strip malls. And it was the most gangster like way of doing business in hindsight I've ever seen. Again, you know, my first job out of school, so I really had no idea, but in hindsight, it was unbelievable. So their business model, basically they would send out checks to everybody in the mail, $5,000 checks. And if the person signed the back of them and deposited them at the bank, it initiated a loan that was like a 35% loan. So these people would get these checks in the mail and they'd be like, oh, cool, $5,000, sign, boom. And then at that point, they're in the system and we can call on them. And so we'd call them and they'd send them out to homeowners, right? And we'd call them and we'd be like, oh, well, we have these third lien products that we, at the time, I still can't believe these things existed. These third lien products would allow you to lend on a person's home up to 125% of the value of the home. It was a third lien, so first, second lien, third lien, and it was also at like 28%, but it was a slightly longer term. So you'd wrap up some of their bills and you'd pay off this gangster loan that they took, and you'd do that product. Or then you'd get the second lien product, which was like a 15-year term. It was at like 15 to 18%. I know, it was crazy. And then you'd wrap that up. Or they had their first lien product that was also very subprime. So, at the time, like, prime rates were probably at 6.5. These were at like 7.5, 8.5%. Every product that household finance sold had 5 points on it.
Wow.
Every single one. And that was down from the year prior before I got there when everything had 7.5 points on it.
Wow. Yeah.
It was crazy in hindsight.
I know. And for context, for somebody who's not in the mortgage industry, when you say 5 points, you mean 5%. So on a $300,000 loan, which, was probably a California loan 20 years ago.
It was like more like 175.
Okay. Yeah.
This was a long time ago.
But still 5% on that, the loan officer is going to make 10 grand on a $200,000 loan.
That wasn't what we were paid though. We were paid peanuts, but that was what the company,
right. The company's making 5 points, but now, with competition and a free market, which is a great thing, right? Those spreads have come down to 275, 250, 2.25, depending on what channel you're in.
Yeah.
I love those stories, dude. That's it. What I want to inject here for the average person to hear is anybody who thinks that they're, in the midst of, or we're on the precipice of some big meltdown, some big crash, realize that there was companies that would lend to you based on your stated income, 125% of the value. Oh yeah, your house is worth 200. You can do a loan up to 250 grand. What could go wrong?
Right.
17% second. Like, of course these things failed. Of course there was mass foreclosure. And so to think that like we're anywhere near that, knowing what I know about specifically mortgage and finance, all the real estate knowledge I have aside,
right,
that could never happen again.
Yeah.
And the lending standards are so tight that if there is circumstances where people foreclose, where houses go back to the bank and those things are sold, as REO, it will be such a small fraction of what we saw back then that there's not going to be a flood of inventory. Flood of inventory is what causes prices to come down because supply versus demand. People don't want to hear that, right? They just love the YouTube videos that have a burning house in the background and says, "Oh my gosh, have you seen what's happening in Austin, Texas?"
Right.
I digress.
I mean, just based on my 20-year stint in this game, it is by far the most secure time, from a macro perspective in terms of the business being done, and in terms of the regulations and protections in place to the consumer. It is definitely the most secure time I've ever seen, during my time in the industry.
Right. Yeah. And that's the thing too, is like, sure, interest rates are relatively high compared to what we've seen the last few years. Sure, home prices haven't come down. So you're going to be staring down a mortgage payment that's more than you're used to seeing. But the funny part is the older I get, Dan, I look at it, I'm like, oh my gosh, in 05 or 06. 06 is when me and Kat bought that first house. 6.75% first, 12% second, $2,800 a month was the moon. That was huge.
Right.
And so a lot of people were like, man, this is a huge mortgage payment. Because their parents or people they talked to had $900 payments. Fast forward to, only 5 or 6 years ago, when I would propose a $2,500 payment to someone, they were like, oh my gosh, this is wild. $3,000 payment.
Right.
People would die for a $3,000 payment in 2024, right? The average home in a market like Sacramento of 500 grand, if you're a first time home buyer putting 3.5% or 5% down, you're probably paying more than $4,000 a month.
Oh yeah.
And so I think it's all kind of perspective, and then realizing that real estate is really a long-term play.
Yeah.
Whether it's your primary or whether it's investment property. So I'd love to talk to you about your personal experience with real estate. Cause like you said, you've owned and sold vineyards. I know you've got investment properties on the side, but through these last couple decades, you've owned some real estate. I'd love to hear about your experience there. Maybe even some lessons, like you said, maybe you wouldn't have bought the vineyard,
or the properties in Kansas.
Yeah, let's talk about Kansas.
I know you know what I'm talking about because you warned me, and I was like, no, it'll be good.
My cheaper ain't always better, Dan.
Yeah. It's hard to manage properties when you're half a country away. So that was a lesson learned, and it's hard to manage properties that you think, oh my gosh, the ROI is so great buying in Wellington, Kansas, because you can buy a house for $25,000, and get $600 a month in rent. But people often, when they're looking at investment properties, don't think about everything that goes into owning a home. It's not just the mortgage and the property taxes and the insurance. Kansas apparently is inflicted with hailstorms, with hailstones that are like this big, and they'll decimate your roof.
Wow.
It's like not uncommon that they have to replace an entire roof in the winter because of hailstorms.
Wow.
Luckily that didn't happen to me, but there was a myriad of other problems. I sold those properties before we experienced a hailstorm like that, but apparently that's a problem that they have out there. So it's like, maintenance, I think, is a much bigger number than people generally consider. Like I've heard people that talk about real estate, they're like, oh, think of one mortgage payment a year for maintenance. And I'm like, no, that's super light.
8% is probably not enough.
Super light. Yeah. In my opinion, or in my experience anyway. But no, I love real estate. I still think it's one of the greatest investment vehicles because, people are always going to need places to live. So I think it feels very secure to me. And if you look like, okay, I've been doing this 20 years, other than a 2-year stint, real estate has performed phenomenally. But if you look at like the last 100 years, it's like 4 or 5 years that real estate hasn't seen amazing returns in 100 years. So it does feel like a very smart play. The other thing is real estate pays you in so many ways. Like even if if someone came and said, hey, I'm going to give you $40 million worth of real estate, but it's going to have a lien of $40 million on it. It's still pretty smart to take that because of all the different ways that you make money with real estate, with depreciation, with write-offs on the interest. Like there's so many different ways that you can make money, cash flow obviously being the most obvious, but no, I'm a huge fan of it still and own a bunch of real estate. I think I've got, about $5 million or so in real estate right now. So,
yeah. And to your point too, like just a quick overview for people, it's like, you're going to have debt pay down where every month you make the mortgage payment, you're going to owe a little bit less because some of that's going to go towards principal.
Which is like a forced savings plan,
right?
Which is so great.
Right. Which people just, that's the magic in it. Like I see people's finances every single day. Mm-hmm. So when I tell you that I think that it's hard for people to save money, it's hard for people to, develop that discipline muscle and stick to it.
Yeah.
I know it because I literally look at it every single day with people's finances. I'm guilty of it myself.
Sure.
Where you make that mortgage payment, you're making a housing payment no matter what you do.
Well, but especially if someone else is making a
mortgage payment for you. Or you have a tenant making a mortgage payment.
That's where it's great.
Oh, trust me, dude. Like I've got a handful of properties and I'm a math nerd, dude. Like $4,700 a month in debt pay down.
Yeah.
Like so if you look at liabilities versus assets and you're doing a net worth calculation, like on autopilot, $4,700 a month.
And let's say, maybe you weren't as pleased with your last month's commissions as you normally are. You had a rough month. At least you can remember, $4,700.
Well, yeah, I owe $4,700 less, on 3.3 million, even if the market only appreciates 2% a year, which is like California's last 39 years is 6.9%. I think that's the number. Mm-hmm. So like, if I use 6.9%, that'd be like 200,000 a year in appreciation, but let's just use 2%. Right. And so if it's going up 60,000 a year, that's 5,000 in appreciation. So I've got
Mhm.
5,000 in debt pay down, 5,000 in appreciation, like on autopilot.
It's
right?
awesome.
And so that's where, and then there's, of course, tax benefit and whatnot. I don't want to get off of the subject of real estate without digging a little bit into Kansas. Because I want to know, I want all the ugly details, because I don't know if like you said, maybe I would have been like, Dan, I don't know if that's the best play.
I think you did actually say that to me.
Yeah.
Ultimately I didn't lose any money on it. So I don't mind, I've lost money on plenty of investments. That's part of investing, is sometimes you win, sometimes you lose. And I didn't lose money on the Kansas properties, but they weren't like a positive investment. And like, I lost time and I lost headache and I lost stress over having to deal with them. It was like, they were, at one point I owned 4 different properties, I think, had tenant turnover. The properties were, when you're buying properties for 25,000, you're not exactly buying like the nicest homes in town. So there was, constantly problems with contractors having to get stuff done, and it's all remote. So you just never know what's going on. You're like,
Yeah.
are these
Here's an invoice for $1,100
that I'm getting even the property? I have no idea.
Yeah.
So, in hindsight, like I probably wouldn't, I'd do it differently. I'm still not opposed to buying property out of state, but I'd probably buy like apartment complexes is more what I'd be inclined to be interested in going forward than SFRs.
Yeah. Yeah. I mean, I think what my lesson in Alabama was, because I had a similar, it seemed like a great deal. It was relatively cheap, but you don't realize that like it's easy to have 2 months vacancy and repair expenses that exceed the whole year's rent.
Yes.
And same thing with me, where it wasn't the money loss that really hurt me. It was the, distraction,
Yes.
headache, and stress coming from like, oh my gosh, I got to sell these friggin' Montgomery, Alabama properties. But what was I saying? Lost my train of thought there.
Yeah.
Sorry, this will be edited out.
Yeah.
But before, okay. Real estate. All right. So,
we were talking Kansas. You wanted the down and dirty details.
Yeah, you gave me
too embarrassed to give you all the down and dirty details.
Yeah, it's okay. You gave me
I gave you some
light overview. Maybe I want to hear about the plans for Answer Home Loans. I know that you guys have kind of revamped, and as you see the light at the end of the tunnel, you've got big dreams. Was that 900% year over year? Was that a true number?
Well, I mean, yes, but like we're talking from inception to this year 2, so not really a true number.
Oh, so you were talking about maybe just the core side?
Yeah, just Answer Home Lending.
Yeah.
It wasn't the both companies.
Right. Yeah. Refinance is up 94% year over year.
So it was a true number for the new company we started.
Yeah.
But it always looks like that in year 1 if you're at a company that's growing.
Yeah. So what are your plans for future growth? It's an interesting conversation, whether it's a business or whether it's investments that I feel like I've had more of these conversations, and I've started to see both sides of it. Like, is bigger better? Is there a certain size where you're like, you know what, if we had a company with 150 great originators and we were doing this much business, this would be like the perfect size. What do you envision for the next 5 or 10 years? Of course, like subject to change, right?
Yeah, of course. So I do want to pursue growth. I feel like if you're not moving forward, you're going backwards. So I definitely want to pursue growth. I want to pursue it in much the same way we have, which is finding more great partners, loan partners to partner with Answer, whether that be on our pure wholesale channel or our correspondent channel. But I always wanted to do it with a measured pace, right? There's been times where it's grown really quickly, and I like measured growth because, I like to not feel out of control. And, there was a time in 20 and 21 where things got pretty big, and, we had a lot more overhead, and it felt, even though it was great, we were having a ton of success. There were times where I felt like I was less in control, and, that's not as comfortable a feeling. Right. So like, I do like measured growth, but I'm, if a team of 100 LOs called me tomorrow, I'd figure it out.
Right.
you
Yeah.
know?
Yeah. It's always fun to think about. And then I know, my own personal business, some of the same stuff like you're talking about, like you grow and it's out of control and you probably don't have a great handle on expenses, but it's okay because times are great.
Right.
You learn and you adapt. But looking out into the future, what's going to change for loan officers and for companies? And I think I want to ask this question because to me, I just have this new kind of perspective on things where this next kind of run, rates come down, refinance comes back. It's only been a few years since the last kind of refinance boom, and it's changed drastically.
Yeah.
Like technology has changed drastically. The way that companies are structured and how they do business has changed drastically. So is there going to be, is it going to be more competition because there's AI chatbots that can get somebody
For sure.
from,
Well,
initial
I also
call?
think something that we haven't, well, we're probably experiencing it, and you could probably talk about this better than I can. But the competition is stronger probably. Because like you had said earlier, there's only about 80,000 originators nationwide now, down from like a high of over 300. Tough times separate the wheat from the chaff. And so what's left is the wheat. The strong LOs are those 80,000 left. So not only are you competing with them, but it's a harder competition because they're at a better level. But you talked about the AI chatbots and things. I mean, AI is real,
Right?
Like, I don't know if I told you, but my wife and I went to San Francisco a couple months ago, and we stayed in the Presidio. And I rode in an autonomous driving car all over the city. Like, I was like, I'm going to try it. And once I tried it, I was like, I'll never not do that again.
Wow.
It was half the price of Uber, and it had no driver, and it drove us all over the city. And it drove us through some crazy situations. Like, we went through Chinatown at one point. There were people all over, like people walking through the road. It handled all of it.
Wow.
Seamless.
You were not scared at all?
No, I was like I had a little nervousness when we started, but then I was like, oh my gosh, this thing is competent.
Right.
And it was unreal. At one point, even we were going uphill, we were stopped at a stoplight. Someone started backing into us. The car honked at them, backed up. They pulled away, and it was no problem.
Wow.
It was crazy. So I'm like, if they can build a car that can handle San Francisco, which I was always terrified of driving.
Oh, San Francisco is not an easy place to drive.
It's terrifying to drive there. I mean, if it can handle that and no problem, like, there's a lot we can do with AI. That was like pretty eye-opening to me. And so I definitely think like AI is going to play a bigger role in our industry. It's already happening. I think the best LOs will leverage it. And I don't think the human interaction will ever be completely eliminated, but I mean, that car drove pretty good around San Francisco.
Yeah. I mean, I'm with you on that too, where part of me is like, you know what? I've got a great relationship with some of my past clients. I'm sponsoring the Little League where their kids play. I'm supporting them and giving them great financial advice for all things, not just their mortgage. But I think it was like a year ago, I was at a conference and I'm in this like absorption of information mode. I got a random call from a past client of mine who's a technology guy. And he said, hey, would you be willing to, test this new software for us? And I was like, well, what are you guys working on? And it was one of those chat bots where plug in however much data you want, 4,500 past clients, plug in, certain metrics, and it's going to call them. Hey, it's Sam. I work closely with Matt Gougé over at, U Mortgage. It's going to have all these prompts and it's going to be able to set appointments for you, right? I can't call 4,500 people myself, right? Even though people like and trust me. And so, with that type of technology, a bigger company even takes 100,000 people, whittles it down to the 550 that like a refinance makes sense right now.
Right.
And so like that kind of stuff half excites me, half scares me.
Yeah.
You know, it's balancing that thought process, I think, with the reminder that everybody thought online brokerages would eliminate financial advisors.
Mm-hmm.
Still having a financial advisor that you talk to and you sit down with them face to face. That's not going away anytime soon.
Right.
And I think the same things for, you know, real estate agents, loan officers. But you know, business will change besides technology, AI stuff. What other changes do you see for loan originators? Do you think that we're going to be at a point where they're going to be doing 30 loans a month and be getting paid a third of what they're getting paid now?
Probably.
Yeah.
Yeah. I think margin compression is a reality that we're all going to face. And, you know, with the betterment of technology. I mean, when I got into this industry, or actually not even when I got into it, but like I went to work for a brokerage after AmeriQuest, and we had these things, like this is how we did loans back in the day. We'd have a stack of paperwork and we'd print it all out, and like the different lenders that we work with had like a printed list of a stacking file. And so you'd take your deal and you'd put all these forms that you needed in it based on their list and check it off. And then you'd hand write in the information about the loan on this form. And you'd stack it all together and maybe clip it with like a gator clip or something. And you put it in this thing called a trans box, which was like pre FedEx and UPS. Before people really started using those, they had these things called trans boxes. And then in the evening, you'd run them over to like the grocery store that had these trans boxes there. You'd have like 10 of them or whatever, how many loans you were submitting that day. This was as a company. I wish it were 10 loans of mine.
Right. Yeah.
And you'd seriously put them in this trans box, and then they'd pick them up and physically drive this stacked paperwork to the lender. And then the lender would, you know, take 3 days to underwrite the file or whatever. Like that's how we did it in like 17 years ago.
Right.
Not even that long ago.
I agree with you wholeheartedly. And I think it was funny. I had somebody send me a message today that was kind of poking fun at a company that was basically saying, hey, let's go capture some refinance market share and let's do it at a smaller margin.
Yeah.
And this person was like, oh, you know, like, why are these guys racing to the bottom? It's not necessarily racing to the bottom, in my opinion, but in those days, if it took 10 hours of your labor to close a loan where you made a $3,000 commission, you're making $300 an hour. Yeah. What if you've got Arrive software that can price 7 different lenders at once? There's no more rate sheets, right? And what if like all the technology makes the whole thing 10 times more efficient to where it's 1 hour of your time, right? And so, you know, if you get to the point where loan officer commission is $1,000 on that same size loan, but it took you 1 hour versus 10, you're making more per hour. Yeah. And so I think I had that thought, and I feel like it's been talked about for 5 years. Yeah. And it really, like a lot of things, I guess it's slow to kind of work in, but to a certain extent it kind of has. I feel like retail mortgage companies have had to get leaner or die. And then, you know, all mortgage companies across the US are kind of competing with the low price models, which are, you know, huge call center, you know, get great service. You got a kid on the phone who doesn't even understand how to spell mortgage, let alone structure one. So yeah, I think margin compression is real. What other changes we got coming?
Oh man.
What's going to happen to all the old folks in mortgage? Because the average loan officer, I don't know if they've updated that study, but it used to be like 55 years old. I know that I've seen, you know, I feel like an older guy now.
I think I employ them all.
You've got all of them. So the next gen, which, you know what, that's a question I'd love to ask you, because I don't know if I've found the answer to this for new loan officers starting. Somebody sees me on social media or knows me and they're like, Matt, look like you're having a lot of fun doing home loans. It seems cool to be able to help people out with, you know, investing and creating wealth, or, you know, living the dream and buying their own home. I want to get started. Where should I go to get trained?
Well, I still think they should go to call centers. You know, that's a young person's game. And you're going to trial by fire in those environments, but it's valuable. Like I was actually at a surprise birthday party for a buddy of mine who turned 50 the other day. And I was talking to a couple of his friends and they're like, yeah, my son's like living at home and, I'm frustrated. I can't, I don't know what to do with him. And I was like, look, like the college thing didn't work out for him, right? That's okay. Like, a lot of people don't go through that, don't take that path in life. But I'm like, just, have him go get a sales job. Like you can make so much money doing sales, make a great life for yourself. I'm like, go, a kid like that, if he can go 8 hours a day in a call center environment, he's going to learn a lot. You can get competition if they're the type of person that likes, a competitive environment. You can have a good time. Despite what we said about some of the call centers that we talked about earlier.
Right. Yeah.
But yeah, no, I don't think there's anything wrong with that type of environment. And I do think it's the right place to learn. Cause like you said, I get so many people that come to me and are like, oh, I want to work at Answer. And I'm like, no, like, this isn't the place for you. Like, we're not going to give you the things you need to be successful. And so you need to go do this for a while and then call me in a couple of years. And so that's a conversation I have a lot, but, I think that'll continue.
Yeah. Yeah. I feel like that's probably something that's lacking. So anybody who's listening, who's in the mortgage space, the next generation of loan officers, probably want some sort of, formula or structure for getting from brand new to, I'm competent and I can go out and talk to clients. For a lot of us, myself included, I remember in 2014, I just had to learn as I went, and I was going to other loan officers. I wasn't closing enough loans to learn fast enough. So I'm like, Ryan, what are you closing? Dan, what are you closing? Nick, what are you closing? And try to learn.
But yours was pure grit. Like, and we talked about this earlier. Like the reality is 99% of the population doesn't have what you have to get to do it that way. Like that, I saw it firsthand and it was impressive. And I was like, I remember when you were working the card room and you'd sleep under your desk because you were, working 20 hours a week. So like that,
20 hours a day,
20 hours a day. Yeah. 20 hours a day. Sorry. I misspoke there. That just is another level of commitment and confidence in yourself that you could see the light at the end of the tunnel. Right. And I remember having conversations with my partner, in that endeavor and being like, I have no doubt he's going to be successful.
Yeah.
Like, even though it took you a couple years to really crack it and really start going. Like, I remember multiple conversations where I was like, I have no doubt in my mind. Like, cause it was just evident, you had the tenacity that most people don't have,
Appreciate you, buddy.
Bud.
It's good to hear. And I agree too with like your advice to your friend. Man, what a great, thing to have is sales skills.
Yeah.
And really the best way to gain sales skills is to go out and sell.
Yeah.
Right. Go out and have the conversations.
Yeah.
Nothing really replaces the reps. And I think that's, my advice to the new ones starting out is get wherever you need to get get reps. Yeah. I've talked to people, I'm like, maybe you go work and you're an assistant on a really, really busy team.
Yeah.
When I had my best years of my career, happened to be at Answer Home Loans in 20 and 21. I had great team members.
Probably not an accident.
I had phenomenal team. I remember having the conversations with Michelle and telling Michelle, you are by far like not even close as far as skill level goes, pound for pound versus other loan officers because of the reps, right? Yeah. She didn't have to go out and get the business herself, right? She was helping support my business, which, I was blessed to have YouTube leads and real estate referral leads, but Michelle was getting the reps.
Yeah.
And so those reps are what turned her from, a loan officer who's closing a deal or two a month and had a working knowledge of mortgage to an absolute expert, because of the reps. And so, I think that's for anybody who wants some advice on the Get Better Everyday podcast, whether it's sales, whether it's high school basketball, no matter what it is, like you want to get better at something, you want to get better every day, get some reps in.
Yeah.
And you can't be focused on immediate results. That's another thing that I'm not surprised we went from 340,000 loan originators down to 80,000, because a lot of those 340,000 got in 19 or 20 or 21, put in a little bit of effort, got extraordinary results.
Yeah.
And then was like, hey, what happened? It's a little bit harder in 22. Well, it should be.
Right.
It's like for somebody like me who just loves hard work. Oh man, like I should watch how I frame this, and I should knock on wood. I've had enough hard times. Okay, universe. It's been hard enough over the last 2.5 years. So I'm ready for the light, but it is great because it weeds out the weak. So, cool, man. We've talked real estate. We've talked business. Before we go, I want to talk your number one passion, because I know it's family. So
I thought you were going to say pickleball.
Well, I know pickleball, but I think too, when I talk to people who are, passionate people in general, and they've got, a business, like you're passionate about mortgage. You've been doing it for 2 decades. You love real estate. And that is really a means to an end. At the end of the day, you're like, I'm trying to set my family and my finances, so I've got freedom to go do things I love, to go let a car drive me around in San Francisco, and
it was so cool.
Yeah.
I recommend it.
Right. Well, that's
so
the
cool.
thing too, is if you work hard and you create success and wealth, you get to do cool stuff. You get to do cool stuff with the people you love. So, what are some future plans? I can't believe your girls are going to be 14, man.
I know, it's wild. Right? They're going to be in high school next year.
Yeah, that is crazy. I got a sophomore in high school. Ryan's right down the street at Rio. And then Ethan's a 6th grader. So last year at the elementary school where I went, and so it's a closing of one chapter. Kat, though, is like, got a great perspective on it, that it's like, the next chapter is always great, right? You're closing one chapter in a book, which is sad, but you can't be too sad because you're excited, because the next chapter is going to be a fun and exciting chapter to read too. So, with that in mind, what's the current chapter for the Maybaum family? What do you see in future chapters? What are you excited for there?
Oh man. Brooklyn's doing a lot of acting these days. She's the 4th lead in a production of Annie, which is super cool. Awesome. She's playing the character Duffy, which is a perfect character for her, because I guess it's a real like wisecracking little kid. So I'm excited for that. She's working hard, going to working on that and stuff. But yeah, I don't know. I mean, I want to do some traveling. I want to drag my family over to Europe a little bit, if we can figure that out next year. I'm actually kind of nervous about it, but excited about the prospect. But I don't know if 2 14-year-olds are going to be too excited about it.
Maybe a cruise, or the Gougé family's looking at a Mediterranean
that
cruise.
might be a good compromise.
Right. Yeah. You're going to have great food. You're going to be on a ship.
What, you don't want to go to these museums and stuff with me every day? I don't know. I'm going to force this culture into you.
Yeah. That's part of their educational process. I think that, I've got kind of the same thing where you're busy in business, but you want to create these cool memories. And every time me and Kat kind of force the boys to go out and do new stuff, they're like, oh my gosh, I never thought swimming with manta rays in Hawaii would be so cool.
Right.
And so, we recently got our passports. And so Europe 25 is part of our vision board too, which I'm sure you guys do cool vacations. I see it all online. I'm sure that
we haven't done Europe yet though. Yeah. We haven't left the North American continent. So I'd like to do that.
Neither have we, man. 2025 for both of us.
I know.
Yeah. Maybe we'll meet there. We'll meet on the ship.
Yeah, maybe. That'd be fun. That'd be super fun.
Cool, man. Well, thanks for your time, dude. Any parting words for the Get Better Everyday audience?
Consistency, man. I saw this thing the other day. And it really rung with me. It's like, okay, so let's say you have $100,000 to invest, and you put it in the stock market, and you make 20% in a year, but you make 0 the next year. At the end of that time, you've made 20% on your money, which is phenomenal. But let's say you make 10% each year, and you're getting a consistent return on your investment. You've actually, at the end, not made 20%, but made 21% just because of compounding interest. And I think you can think about the effort that you put in every day in that same way. It compounds on itself, just like in the example of that investment. And so I think consistency is huge in this industry and in life. In general.
Yeah. Agree 100%. Get better every day.
Yep.
Thanks, buddy.
Yeah.